If you've been focused on the equity markets and fear of recession or even the ever changing Trump tariffs, you've been focusing on the wrong thing. At this point of time, the most important thing is the US bond market. Trump has already said that he was focused more on long term gains and he doesn't mind short term pain. This means pushing the US economy into recession or a steep correction in the equity markets. However, the response from the bond market has got him and his administration worried. Here's an explanation why everybody needs to watch out that particular space. As you're aware, US government runs a fiscal deficit of 1.3 trillion dollars. It means that they earn significantly less money than what they spend. Like all governments, to plug that gap, they raise money through issuance of bonds. These bonds are bought by retail investors, countries such as India and China as well. And while you give money to the US government pays you an interest because US bonds are considered extremely safe. They pay a small interest rate, about 2 or 3%. This is very similar to what happens with us. If you have a high credit rating, you get a loan at a better interest rate. Same thing. So US has been able to plug this gap by raising funds through the bond market. What happens is in uncertain times, investors pull out money from the equity markets and move into the bond markets because they want to wait out and enter into the equity markets at a better time. So, like always in the history, uncertain times, people pull out money from the equity markets, move into the bond market. Because a lot of investors are now moving into the bond market, the bond prices or the treasury prices rises, but the quantum of interest paid on those bonds still remains the same. That means that now you're buying bonds at a higher price, so the interest payments by the price of the bond, that is the yield of the bond, is expected to drop down. About 2 weeks back, when we had a significant correction due to tariff policies by Trump, investors pulled out money from the equity markets and they were expected to go into the bond market. However, more people started dumping the bonds as well, as a result of which the yield spiked instead of falling down, which means the bond prices dropped, which is a significant deviation from historic behavior. The reasoning is very simple. If you're going to push the US economy into a recession, that means that your earnings is going to be significantly lower and you might have to spend more money to spur up the markets. That means your fiscal deficit is going to only increase. Now the bond market is saying we are not sure, we are not confident that this is the right way you need to lead the economy, and they're not sure if they will get the desired interest payments from the US government, as a result of which the retail investors are dumping these bonds. Other than that, countries such as India and China, which used to buy a lot of these bonds in the past, have gradually reduced their exposure. This has resulted a spike in yield of these bonds. When these bond yields spike, it has greater repercussions. Everything from business loans, your home loans, your car loans, your personal loans are all tied to the yield of these bonds, and the interest rates on all of the other loans is also going to increase. This will have a significant impact on the people of US, and this will further drag the economy down. So it is very important to see what the bond market is indicating. And in fact, because of this behavior, Trump and his administration had to scale back on their tariff wars and probably will take a more pragmatic approach towards fixing the fiscal deficit as well as trade deficit. So keep an eye on the bond market. It is deviating from what has happened in the past, and that will have huge implication and repercussion on just not the US economy but global economy.